Every business, stock, and company you trust with money leaves a paper trail. If you can't read it, you're guessing. This is how money actually tells you the truth. Financial statements sound complicated, but they're just organized answers to three simple questions. Did this business make money? What does it own and owe? And where did the cash actually go? If you understand financial statements, you stop trusting opinions and start trusting numbers. So what is a financial statement, really? Think of it like a report card for money. It's a simple document that shows you the truth. It reveals a company's performance, its actual stability, and the reality behind the marketing hype. So the first step is to stop thinking of this as accounting. Start thinking of it as evidence. Every business, from a corner coffee shop to a global tech giant, uses three core statements: the income statement, the balance sheet, and the cash flow statement. Each one answers a different question about the business. If you miss one, you miss the whole picture. It's like trying to understand a person by only looking at one photo. You need the whole story. So let's start with the first one, the income statement. This answers the question, did the business actually make money? It's the most straightforward of the three. It shows you the revenue, which is all the money coming in from sales. It shows you the expenses, which is all the money going out to run the business. And it gives you the bottom line, profit or loss. The formula couldn't be simpler. Revenue minus expenses equals profit. Now, the biggest mistake beginners make here is thinking that revenue equals success. They see a company with massive sales and assume it's thriving, but that's a trap. You should always look at the net profit, not the sales figures. Profit tells you if the business is actually sustainable. After all, big sales with no profit is just expensive activity. If this already makes finance feel simpler than you expected, subscribe. This channel breaks money concepts down without the fluff. Okay, let's move to the second report, the balance sheet. This one answers a different question. Is the business financially strong? Think of it as a snapshot of the company's health at a single moment in time. It shows three things: assets, which is everything the company owns that has value; liabilities, which is everything it owes to others, like loans and bills; and equity, which is what's left over for the owners. The formula that holds it all together is assets equals liabilities plus equity. Why does this matter so much? Because it shows you the company's debt levels. It reveals its financial stability or its fragility. So when you look at one, compare the assets versus the debt. If a company has mountains of debt compared to what it owns, it's fragile. It's walking on a tightrope. This is crucial because a company can be profitable and still be broke. That brings us to the third and in many ways the most important statement, the cash flow statement. This one answers the most fundamental question: where did the cash actually go? It tracks the real movement of cash in and out of the business, separating it into three activities: operating, investing, and financing. This statement is so critical because profit can be manipulated with accounting tricks, but cash is much harder to fake. Cash is reality. So when you look at this statement, look for positive operating cash flow. That means the core business is actually generating more cash than it's spending, because if cash isn't coming in, nothing else matters. Cash flow keeps the lights on. So how do these three statements work together to give you the full picture? Here's a simple way to remember it. The income statement is about performance, the balance sheet is about strength, and the cash flow statement is about survival. You should never, ever judge a business using only one statement. One statement lies, three together tell the truth. And this isn't just for Wall Street analysts. You use these skills all the time. You use financial statements when you're thinking about investing in stocks or evaluating a small business you want to support. You use them to check if your own employer is stable. You use them to understand what's really going on when you read company news. So before you trust the headlines, check the numbers. The market reacts to stories. Smart people react to statements. The single biggest mistake people make when they start learning this is that they try to memorize terms instead of asking questions. Forget the jargon. Instead, just ask the simple questions the statements are designed to answer. Is this business profitable? Look at the income statement. Is it drowning in debt? Look at the balance sheet. Is cash actually coming into the business? Look at the cash flow statement. Finance rewards curiosity, not memorization. So let's do a quick 60-second summary. The income statement tells you about profit, the balance sheet tells you about stability, and the cash flow statement tells you the reality. Understand these three and money stops being mysterious. Financial statements aren't for accountants, they're for anyone who wants to stop guessing with money. Once you learn to read them, every business starts telling you the truth, whether it wants to or not.